So if you ever watch a master illusionist, do their thing, the entire performance really relies on this one biological hack.
Oh, misdirection.
Exactly, misdirection. So the magician makes this grand, sweeping gesture with their right hand right. There's a sudden flash of light, or maybe a burst of colored smoke.
Right.
Or a loudly snapping silk handkerchief.
Mm-hmm.
And as a human being, your brain is just evolutionarily hardwired to track that sudden, dramatic movement.
You literally can't look away from it.
You can't. Your eyes are completely glued to the right hand. And while you are staring at that grand gesture, the left hand, the quiet, boring, completely unflashy left hand, is doing the actual work.
Yeah, that's where the trick actually happens.
Exactly. It's palming the coin or, slipping the card into the pocket. The reality of the entire situation is completely hidden in plain sight, just waiting for you to look away from the fireworks.
And, well, the financial markets operate on that exact same psychological principle.
Oh, 100%.
Wall Street algorithms and, reactionary retail investors, they are constantly drawn to the most dramatic stimulus on a balance sheet.
They want the easy narrative, the highly visible one.
Right. But to understand the true mechanics of a business, to figure out how the trick actually works and where the cash is really flowing, you have to train yourself to ignore the flash.
You have to watch the quiet hand.
Exactly.
Welcome, everyone, to a special Talk Tickers edition of The Deep Dive. We are thrilled to have you with us. Today, we are tearing apart the corporate spin and the Wall Street jargon.
And we're getting straight to the numbers.
Right, because our mission here is to translate those dense, sleepy academic earnings reports into actionable insights for you, the retail investor.
Yeah.
We want to show you exactly how the financial illusion works.
Because the ultimate financial misdirection is happening right now.
It really is, and it's happening with Fox Corporation. For those following along, that's trading under the ticker symbol FOXA.
So we've got the fiscal third quarter 2026 earnings call transcript in front of us.
We do. And if you pull up your brokerage app right now and just glance at those headline numbers, your eyes are immediately drawn to this terrifying top-line figure.
It looks really bad at first glance.
It looks awful. It's a 24% drop in total company revenue, $4 billion, down nearly a quarter from the previous year.
Right, which is huge.
So if I just see a 24% revenue drop, my natural reactionary instinct is to absolutely panic.
Sure. Because a cratering like that usually signals a totally broken business model.
Or a massive loss of market share, right?
Yep.
So why shouldn't the listener panic right now?
Well, this is where you have to look at the quiet hand, which in this case is the bottom line profitability.
Okay, lay it on us.
While the top line looks like it's collapsing, Fox just posted an adjusted EPS, its earnings per share, of $1.32.
Which is actually up, right?
It is up 20% from $1.10 the previous year.
Wow.
Yeah. And their adjusted EBITDA jumped 11% to nearly $1 billion. $954 million to be exact.
So wait, total sales are falling off a cliff, but profits are accelerating at double digits.
Setting a third quarter record, actually.
That feels like a massive contradiction. How does that math even work?
So the foundational key to unlocking this massive discrepancy lies in what the industry calls a tough comp.
A tough comparison to the previous year.
Exactly. But specifically, we need to look at the sheer economic gravity of the Super Bowl.
The Super Bowl hangover.
Right. In the exact same quarter last year, Fox broadcast Super Bowl 59.
Okay, so that totally skews the numbers.
Completely. When we talk about a 24% revenue drop, we aren't talking about a systemic failure of their ad sales team.
Yeah, of course not.
We are talking about the mathematical impossibility of replacing a singular planetary scale television event.
Right, because the Super Bowl is essentially an economic singularity. It just warps the financial modeling of any network that touches it.
I mean, that single broadcast last year generated over $800 million in gross advertising revenue for Fox.
$800 million.
Yeah.
In one night.
Yes. So when you lap that event, when you compare a quarter with a Super Bowl to a quarter without one, the headline revenue number is destined to look catastrophic.
Right. It's mathematically guaranteed.
Management actually guided for a 30% decline in the television segment's advertising revenue, precisely because you cannot manufacture $800 million out of thin air on a random Sunday in February.
You just can't. But revenue is only half the equation of that broadcast, right?
Exactly. And this is where the magic trick happens. Broadcasting the Super Bowl requires a gargantuan outlay of capital.
You can't even imagine.
You are paying astronomical sports programming rights amortization fees to the NFL.
Basically the rental fee to show the game.
Yes, and it's massive. Plus, you have thousands of production staff, endless miles of fiber optic cable, multi-million-dollar sets constructed on site.
Satellite uplinks, massive security protocols. It's a wildly expensive endeavor.
Right. So when you remove the Super Bowl from the current quarter, yes, you lose the $800 million in revenue. But your television segment expenses absolutely plummet. In Fox's case, those expenses fell by 24%.
Which triggers an incredible amount of operating leverage.
Exactly. They didn't make the $800 million, but they also didn't have to spend the hundreds of millions required to put the spectacle on the air in the first place.
So without the heavy burden of those production and rights costs, the core day-to-day operations of the network just shone through.
Right. If you look at the EBITDA, which for the listener is just the actual operational cash flow before you strip out taxes and interest, at their television segment, it hit $191 million.
Wait, so the TV segment EBITDA was $191 million.
Yeah. That is more than 3 times the level they posted in the exact same quarter the prior year.
Even when they had the big game.
Even when they had the big game. It proves that the underlying non-Super Bowl business is operating at a vastly superior profit margin.
So it's kind of like a restaurant analogy, right?
What do you mean?
It's like a banquet hall that didn't host a massive, wildly expensive wedding this weekend.
Oh, I see where you're going.
Right. So their total sales are technically down because they didn't get that huge check from the bride's family. But their regular dining room was so packed and the food costs were so much lower that they actually took home more pure cash at the end of the night.
That is a perfect analogy. The core business is actually booming.
So since the Super Bowl clearly skewed the top line, let's surgically remove it for a second. If we wipe away the NFL noise, what does the core underlying business actually look like?
Well, the CFO, Steve Tomsic, made a point to isolate that core business on the call.
What did he say?
He noted that excluding the Super Bowl and other NFL playoff shifts, total company advertising revenue actually grew double digits year over year.
Double digits?
Yeah. And in a media landscape where legacy broadcast networks are fighting tooth and nail just to maintain flat revenue, double-digit core growth is a profound outlier.
It really is. And from what I saw in the transcript, the primary fuel for that double-digit growth is basically just the Fox News platform.
Oh, absolutely. Lachlan Murdoch dropped a metric on the call that frankly defies the broader media narrative.
Yeah, Fox News achieved its highest third-quarter advertising revenue in the history of the network.
Right. They didn't just tread water, they broke internal records.
Which is wild.
They finished the quarter as the most watched cable network in total day in primetime. They are commanding a staggering 57% share of the audience.
57%. I mean, capturing more than half the available audience is practically unheard of today.
And that dominance isn't fading either. By April, they were outperforming all but one of the major broadcast networks in Monday through Friday primetime.
Which grants a network borderline monopolistic pricing power, right?
Oh, yeah. And the advertising upfronts and the scatter markets, they have total leverage.
So what does that look like in the actual data?
Management reported that their CPMs are up over 45%.
Okay, let's translate that piece of jargon real quick for the listener. What exactly is a CPM?
Sure. CPM stands for cost per mil, which is just the Latin word for 1,000. It's the cost an advertiser pays to reach 1,000 viewers.
So the cost to reach 1,000 people went up 45%.
Yes. Alongside national pricing gains, we are seeing a fundamental imbalance in supply and demand here.
Right, because audiences are fragmenting across TikTok, YouTube, all these niche streaming services.
Exactly. The pool of live, scaled, concurrent viewership, meaning millions of people watching the exact same thing at the exact same time, is evaporating.
But because Fox News still aggregates massive concurrent audiences, advertisers are basically forced to pay a massive premium to access them.
Exactly. And they aren't just squeezing their existing clients for more money either. No, they added over 500 new premium advertising clients across fiscal 25 and 26.
Wow. Okay, so when you have a 45% pricing hike combined with hundreds of net new enterprise clients, you start to really understand how those margins are expanding so rapidly.
It's a cash machine.
But looking forward, the true catalyst for this advertising engine isn't just national corporate brands, is it?
No, it's the impending multi-billion-dollar wave of political spending.
Right. Management cited third-party estimates projecting an $11 billion political ad market for the upcoming midterm cycle.
Now, before we dig into the mechanics of how that $11 billion is going to flow through Fox's balance sheet, we need to establish a very rigid framework for this analysis for our listeners.
Yes, absolutely. We must emphasize this point.
We are analyzing Fox News, its local affiliates, and the broader political media landscape purely as financial assets.
Strictly financial.
We follow the EBITDA, not the ideology. We're looking at this strictly through the lens of a retail investor evaluating monetizable advertising vehicles.
Whether the political messaging skews right, left, or center is completely irrelevant to the capital allocation strategy here. The market does not care about the political leaning of an advertisement.
It only cares that the invoice clears.
Exactly. And those invoices are going to be massive.
Huge. And while a portion of that $11 billion will land on the national cable network, the real hidden gold mine is the local affiliate structure.
The local stations.
Right. Because political campaigns, by their very nature, are geographic. If you were running a gubernatorial campaign or a Senate race, buying national airtime is highly inefficient.
Yeah, you don't want to pay to reach voters in Oregon if you're running for Senate in Ohio.
Exactly. You need to target specific media markets. And Fox owns a highly strategic portfolio of local stations concentrated in major battleground states.
They specifically highlighted Florida and Georgia on the call.
They did, alongside massive issue money markets like California.
Issue money?
Yeah, ballot propositions and local initiative. Those campaigns often command war chests that rival presidential runs.
Oh, wow. I hadn't thought about the proposition money.
It's massive. And the mechanism of political advertising on local television is incredibly sticky. Well, despite the rise of digital micro-targeting on social media, political action committees and campaign managers still rely heavily on local broadcast TV.
Because that's where the actual voters are.
Exactly. It consistently reaches the exact demographic most likely to show up at the polls. Older, highly engaged, local news viewers.
That makes total sense.
And what is particularly bullish about Fox's current quarter is that they are already reporting record political revenue for an off year.
Wait, really? The cycle hasn't even fully started.
Right. But the PMOSI money and issue-based ad spends are flowing into their local affiliates months before the primary season traditionally heats up.
So it creates a perfect storm for market expansion.
Exactly.
You take a double-digit underlying growth rate in core advertising, you inject a 45% pricing premium, stack 500 new corporate clients on top of that, and then funnel a disproportionate share of an $11 billion political cycle into your local affiliates.
And that is exactly how you generate nearly $1 billion in quarterly EBITDA despite a 24% drop in headline revenue.
It's just brilliant misdirection.
It is. But we do have to play devil's advocate here.
Yeah.
High advertising rates are ultimately just a Band-Aid if the underlying audience disappears entirely.
Right, which forces us to confront the structural elephant in the room.
The erosion of the traditional pay TV ecosystem.
Cord cutting.
Cord cutting. The prevailing narrative across every financial blog and analyst desk is that linear television is in a terminal death spiral.
Everyone says cable is dying.
Right. Yet Fox reported that their cable segment revenue actually grew by 6%, hitting $884 million.
How is Fox's cable segment actually growing if everyone is canceling cable?
The mechanics of that 6% growth expose the massive leverage Fox holds over the cable providers. The cable distribution revenue grew 5%, specifically because their pricing gains outpaced the impact from net subscriber losses.
Okay, let's break that down for the listener.
Sure. The total pool of cable subscribers, the people actually paying Comcast or Charter every month, is undoubtedly shrinking. But Fox is negotiating higher affiliate fees per remaining subscriber.
So they are charging Comcast more money for every person who still has a cable box.
Exactly. And the Comcasts and Charters of the world are forced to agree to these rate hikes because Fox holds the two most critical pieces of leverage in the linear bundle.
Live news and live sports.
Live news and live sports. If a cable operator drops, say a regional sports network or a niche lifestyle channel, a few subscribers might complain, but the overall churn is manageable.
But if they drop Fox...
If a cable operator blackouts Fox News and Fox Sports during an election year or an NFL season, they will face an immediate catastrophic exodus of their most loyal, high-margin subscribers.
They would revolt.
They absolutely would. Fox knows this, the cable operators know this, and it results in Fox successfully pushing through pricing increases that perfectly mask the volume decline of cord cutting.
But the physics of that pricing power have to have a limit, right? I mean, you cannot raise the toll indefinitely if the bridge is slowly collapsing into the river.
Right. Eventually, the rate of cord cutting has to catch up with the rate hikes.
Which makes management's update on subscriber erosion incredibly vital.
It was a very important data point on the call. They noted that subscriber losses have stabilized below 6.5% for several consecutive quarters.
So the bleeding hasn't stopped completely, but they've applied a highly effective tourniquet.
Exactly. The rate of decay is predictable now, which allows them to model their price increases perfectly.
And what's driving that stabilization?
It's heavily influenced by their strategic transition into owned and operated digital platforms. Specifically, this initiative they call Fox One.
I saw they mentioned a lot. Can you explain Fox One for the listener?
Sure. Fox One basically serves as a direct-to-consumer aggregator for their news, sports, and entertainment IP outside the bounds of the traditional Coax cable bundle.
Like their own internal app ecosystem.
Right. But what is highly revealing about Fox's corporate accounting is their intentional conservatism regarding this new platform.
How so?
Well, Lachlan Murdoch explicitly stated that they are not yet including the newly acquired Fox One subscribers in that 6.5% linear decline metric.
Wait, so they're showing Wall Street their absolute worst case scenario.
Precisely. The 6.5% erosion is the unmitigated linear decay, totally uncushioned by their own internal digital growth.
Why would they do that? Why not make the numbers look better?
They want a full cycle of data to understand the seasonality and the retention rates of the Fox One user base before they integrate those numbers into the overall subscriber health metric. It's classic under-promising.
So that makes sense. But I have to push back a little here on Fox One. The concern with any standalone app built around live events is seasonal churn, right?
Sure.
It seems highly logical to assume a user signs up for Fox One in September for the NFL season, watches all the football, and then immediately cancels in February after the Super Bowl.
It's a fair assumption, but the internal data they release pushes back on that heavily. Yeah. Churn rates heading into the traditionally quiet spring and summer months remain surprisingly low.
How are they keeping people around when football ends?
The behavioral mechanism driving that retention is the cross-pollination of content. Over 50% of the viewership on the Fox One platform in Q3 was dedicated to news programming.
Ah, the daily habit.
Exactly. They acquire the user with the high-impact seasonal NFL broadcast, but they retain the user with the daily perpetual habit of news consumption.
Right. You don't cancel an app in March if you rely on it every single morning for your daily political or market update.
You just don't. But Fox One is only one piece of the digital puzzle. The broader industry shift involves the rise of virtual MVPDs.
Okay, let's unpack that term. Virtual MVPDs. We're talking about the skinny bundles, right?
Yes, platforms like YouTube TV, Hulu plus Live TV, Sling.
Right. And originally the skinny bundle was feared as the ultimate destroyer of cable network margins.
It really was. The theory was that consumers would ditch the bloated 500-channel package for a streamlined $40 a month digital bundle that excluded all the expensive Tier 1 networks.
But the exact opposite happened.
The exact opposite. Skinny bundles realized very quickly that they couldn't survive without live sports and local news.
So Fox positioned itself not as some peripheral add-on, but as the foundational anchor tenant of the virtual bundle.
Exactly. As millions of consumers migrate from legacy cable boxes to YouTube TV, Fox's affiliate fees seamlessly migrate right along with them.
So the delivery mechanism changes from a coaxial cable to a broadband connection, but the revenue stream for Fox remains entirely intact.
Yes, the toll bridge still stands.
Fascinating. Now, while the cable and skinny bundle ecosystems are stabilized through pricing power, the true battleground for the future of media is the pure streaming sector.
Oh, the streaming wars.
The streaming wars. And if you look at the legacy media giants, Disney, Paramount, Warner Bros., Discovery, they have basically immolated tens of billions of dollars over the last 5 years trying to build premium subscription-based streaming apps.
It's been a bloodbath.
They took on massive debt to fund prestige television. They aggressively undercut each other on monthly pricing, and they created this environment of rampant, unsustainable subscriber churn.
Right, people hopping from app to app just to watch one show.
Exactly. Against that backdrop of industry-wide cash burn, Fox's primary streaming asset, Tubi, stands out as a total anomaly.
It really is the crown jewel of their digital portfolio.
So let's fire off the data on Tubi.
The metrics are staggering. Tubi revenue grew grew 23% in the quarter. Total view time spiked by 19%.
And how many users are we talking about?
They have scaled the platform to nearly 100 million monthly active users.
Nearly 100 million.
Yes. But honestly, the sheer scale of the user base is secondary to the most important data point,
Which is
the profitability miracle. Tubi has been break-even or better for 3 consecutive quarters.
Wait, they are actually making money on streaming?
They are. Fox is operating a rapidly scaling, high-growth digital streaming platform that is actually contributing to the bottom line rather than draining it.
That is so rare for a legacy media company right now. How are they doing that?
Well, the mechanics of Tubi's profitability lie in its structural divergence from the rest of the industry. Tubi is not an SVOD.
Okay, SVOD meaning a subscription video on demand platform.
Right. They aren't asking consumers for $15 a month, which means they don't suffer the massive customer acquisition costs and churn associated with the subscription model.
Because it's free.
Exactly. Tubi is a FAST platform, F-A-S-T, free ad-supported streaming television.
So it relies entirely on advertising revenue.
Yes. And more importantly, their content acquisition costs are a mere fraction of their competitors.
Let's drill into that because that's huge. The SVOD giants are trapped in an arms race of original content, right?
Right. They're spending $20 million per episode on sci-fi epics and prestige dramas just to convince users not to cancel their subscriptions at the end of the month.
But Tubi doesn't do that.
No, Tubi operates on a library-first model. They boast over 17,000 episodes and films, sourced from over 220 different creators and studios.
So they are licensing vast catalogs of legacy content, reality television, older films, basically at pennies on the dollar compared to original production.
Exactly. They are monetizing the long tail of media history.
And because Tubi has already achieved the critical mass of 100 million users, their need for aggressive, unprofitable marketing campaigns is rapidly tapering off, right?
That was a huge point from CFO Steve Tomczyk on the call. He specifically highlighted that net digital investments for the year are tracking comfortably below last year's $290 million pacing.
So they built the infrastructure, they scaled the audience, and now they are dialing back the capital expenditures
to let the advertising leverage flow directly into free cash flow. Fox basically avoided the subscription bloodbath entirely.
They built a fortress in the free ad-supported space.
And now they are reaping the profits while their competitors try to figure out how to stop bleeding cash.
It's an incredible pivot. But, the engine driving the pricing power in cable, the anchor tenancy in skinny bundles, and the massive top-of-funnel acquisition for digital platforms all leads back to one thing.
Fox's ultimate competitive moat.
Live sports.
Live sports. In an era where scripted television is consumed asynchronously on demand, live sports represent the last remaining bastion of appointment viewing.
You cannot time shift a live football game without having it spoiled by social media.
You really can't.
Yeah.
And because the audience is forced to watch it live, they are forced to watch the commercial breaks.
Which guarantees unparalleled ad completion rates for brands.
Exactly. And even outside of the NFL, Fox is seeing a massive behavioral shift toward their live sports portfolio.
Yeah, look at the numbers from what is traditionally a much softer spring sporting calendar. The World Baseball Classic ratings absolutely exploded.
Up over 150% compared to the previous iteration of the tournament. They had 10 million viewers tune in for the final match.
And Major League Baseball's opening weekend viewership jumped 45%. IndyCar racing saw a 37% increase, posting its best start in years.
The mechanism behind those surges across secondary sports properties is highly indicative of the fragmented media environment we live in now.
How so?
As audiences become increasingly siloed in their respective streaming algorithms, there is a deep psychological craving for communal cultural moments.
The water cooler moments.
Right. A major live sporting event on a broadly accessible broadcast network provides that shared experience.
And while the surges in baseball and racing are fantastic for the margins, the undisputed financial juggernaut of the Fox portfolio remains the NFL.
Yeah, without a doubt.
The scale of the NFL on Fox borders on the absurd. 170 million unique viewers tuned in throughout the regular season.
And 46 million viewers watched the NFC Championship game alone.
It is the most valuable television real estate on the planet, and they actually managed to extract even more value out of the league for the upcoming season.
Yeah, there was some breaking news on the call about that. They acquired the broadcast rights to 2 additional national window games.
Right, a Week 10 triple header broadcasting live from Munich, Germany, and a highly coveted Week 15 Saturday game.
They are systematically injecting premium, ultra-high CPM inventory into their upcoming quarters.
But the sheer dominance of the NFL broadcast package naturally invites intense scrutiny regarding the longevity of the partnership.
Especially as tech giants like Amazon and Apple aggressively circle live sports rights.
Exactly. And during the Q&A portion of the earnings call, an analyst actually brought this up directly. They referenced a Wall Street Journal report suggesting elevated tension between Rupert Murdoch and the NFL.
Specifically regarding the league's creeping migration toward exclusive streaming broadcasts on platforms like Peacock and Amazon Prime.
The fear is that the NFL will slowly hollow out the broadcast networks, right? Moving the most premium matchups behind digital paywalls and degrading Fox's core moat.
That is the fear, yes. But Lachlan Murdoch systematically dismantled that narrative on the call.
What did he say?
He reminded the market that Fox and the NFL share a 30-year operational history. From a purely contractual and legal standpoint, Fox is locked in with 4 years remaining on their current, highly lucrative broadcast deal.
Yeah, so no immediate threat.
No. And Murdoch's response was really a masterclass in corporate discipline. He stated unequivocally that there are no substantive renegotiation talks happening yet, and more importantly, he signaled that Fox will not engage in a bidding war that destroys shareholder value.
So they aren't going to panic buy Thursday Night Football rights at negative margins simply to block Amazon.
Exactly. They know the NFL needs the massive, unpaywalled reach of traditional broadcast television just as much as Fox needs the NFL.
It is a symbiotic relationship, not a hostage situation.
Perfectly said.
And the sports narrative isn't just about defending the NFL turf either. It's about anticipating massive impending catalysts.
And there was no bigger catalyst on the global calendar than the 2026 FIFA Men's World Cup.
The tournament is returning to North America for the first time in over 3 decades. And FIFA has expanded the format to a staggering 104 matches played over a condensed 5-week window.
And Fox holds the rights to deliver the most matches ever broadcast on U.S. television.
Now, the financial accounting for an event of this magnitude requires a highly specific breakdown. How is that going to work?
The CFO laid out the exact timeline for us. The financial impact of the 104 matches will be split perfectly down the middle.
Meaning 50% of the revenue and expenses hit the fourth quarter of fiscal 26.
Right, and the remaining 50% flows into the first quarter of fiscal 27.
So that split structure smooths out the massive capital outlay and prevents the kind of severe single quarter margin distortion we saw with the Super Bowl.
Exactly. And crucially, management confirmed that on a total company basis, the World Cup will be broadly EBITDA accretive.
Meaning they aren't using the World Cup as a loss leader, it will generate pure operational profit.
Yes, but honestly, the advertising revenue generated during the matches is almost secondary to the ecosystem integration strategy.
Oh, this is fascinating. How are they integrating it?
Fox is going to use the World Cup as the ultimate top-of-funnel acquisition tool. They are building a dedicated FIFA hub on Tubi and simulcasting the massive opening matches, including the U.S. men's national team debut.
So they are leveraging the cultural gravity of the World Cup to funnel millions of new users directly into their highly profitable ad-supported streaming ecosystem.
Precisely. It's brilliant synergy.
It really is. Now, before we transition to how Fox is deploying all of this generated capital, we have to examine a heavily obscured asset on their balance sheet that the broader market is currently valuing at nearly zero.
Yes, the sports betting option.
Fox holds an 18.6% option in FanDuel, with over 4 years left on the clock to exercise it.
They also hold a 2.5% direct equity stake in Flutter Entertainment, which is FanDuel's parent company.
This is an incredibly complex and valuable piece of financial engineering. Let's break this down.
To understand the mechanism here, you really have to look at the explosion of the legalized sports betting market in the United States.
Right, which is just everywhere now.
It's massive. And FanDuel is the undisputed market leader, generating billions in handle. Fox secured this 18.6% option during the complex merger and acquisition phase when Flutter bought the Stars Group.
So Fox essentially holds a massive long-term call option on the entire U.S. sports betting industry.
Exactly. And the mechanics of the strike price, And the regulatory hurdles are precisely why Wall Street analysts struggle to price this asset into Fox's current stock valuation.
That's hard to model.
It is. Fox is currently navigating the protracted state-by-state licensing process required to actually exercise the option and take ownership of the equity.
But even while it sits unexercised, it represents a massive sum of the parts valuation floor, doesn't it?
Oh, absolutely. As FanDuel continues to grow its market share and integrate deeper into live sports broadcasts, the inherent value of that 18.6% stake compounds.
It is basically a multi-billion-dollar lottery ticket with a 4-year expiration date, just sitting quietly on the balance sheet.
Waiting to be cashed.
Which brings us to the ultimate question for the retail investor: capital allocation.
Right. We understand the advertising leverage, the pricing power of the cable bundle, the anomaly of Tubi's profitability, and the massive moat of live sports.
The business is clearly generating cash.
A lot of it. Specifically, they printed a staggering $1.3 billion in free cash flow in a single quarter.
Wow, so what are they doing with it?
Well, free cash flow is the purest metric of corporate health. It is the actual unencumbered cash sitting in the bank after all operating expenses, taxes, and capital expenditures have been paid.
It is the ammunition management uses to drive shareholder value.
Exactly. And Fox's management team is deploying that ammunition with ruthless efficiency through their share repurchase program.
The buybacks. Give us the numbers on that.
Fiscal year to date, they have bought back $1.95 billion of their own stock.
Almost $2 billion this year alone.
Yes. And since the inception of the program in 2019, they have repurchased over $8.5 billion.
Now, to understand why this is the single most actionable data point in the entire earnings call for our listeners, we have to look at the exact mechanism of a massive, sustained buyback program.
It's crucial.
Let's look at it like a real estate developer in a highly desirable, geographically locked neighborhood. Say there are exactly 100 waterfront lots in this neighborhood.
Okay, I like this analogy.
If you own one lot, you own 1% of the prime real estate. Now, the developer, the company, takes all of its excess profits, buys 36 of those lots at market value, demolishes the houses, and permanently returns the land to a protected nature reserve.
They will never be built on again.
Exactly. The total footprint of the neighborhood hasn't changed. The inherent value of the water views hasn't changed. But suddenly, there are only 64 buildable lots left in existence.
So your single lot, which previously represented 1% of the neighborhood, instantly becomes vastly more scarce and valuable.
Right. It now represents over 1.5% of the available inventory. The market price of your lot naturally skyrockets because the supply has been artificially and permanently constricted.
And this is exactly what Fox has done. By retiring 36% of their total shares outstanding since 2019, they have engineered a massive structural tailwind for the stock price.
Even if the company's total net income remains perfectly flat, the earnings per share, the EPS metric we saw jump 20% this quarter, will continuously accelerate.
Because you are dividing that profit by a drastically smaller number of outstanding shares.
You own a larger percentage of the cash flow, the voting rights, and the underlying assets without having to deploy a single extra penny of your own capital.
It's beautiful. And a management team aggressively buying back stock at these levels is sending a definitive signal to the market.
What's the signal?
They believe their intrinsic valuation is significantly higher than the current trading price. They view their own equity as the best available investment vehicle.
They are betting on themselves.
Heavily. And when you combine that capital allocation strategy with the underlying operational data we've unpacked today, the final talk ticker's verdict becomes remarkably clear.
The official stance here is undeniably bullish.
Highly bullish.
The headline narrative of a 24% revenue decline is a total illusion. It's a mathematical artifact of the Super Bowl hangover.
When you watch The Quiet Hand, you see a business whose core advertising engine is accelerating at double digits.
You see a news network commanding a 57% market share and securing 45% CPM hikes.
You see a management team successfully using pricing leverage to offset the decay of the linear cable bundle.
You see a digital streaming platform in Tubi that has cracked the code on profitability through an AVOD library model, while the rest of the legacy media industry incinerates capital-chasing SVOD subscribers.
And you have the absolute pinnacle of live sports programming. fortified by the impending windfall of a 104-match World Cup and the off-year surge of a multi-billion-dollar political ad cycle.
And underpinning it all, you have a $1.3 billion quarterly cash machine actively shrinking the float by 36%.
It's incredibly robust.
Fox is a highly efficient, ruthlessly disciplined cash generator disguised by a misunderstood top-line headline.
Which really leaves us with a profound industry-wide question to consider as we close out this analysis.
Right. Over the last decade, we watched a historic era of media consolidation. Disney, Paramount, NBC Universal, they all bet the entire farm on the streaming wars.
They really did.
They sacrificed their highly profitable linear businesses, burned billions of dollars on prestige content, and destroyed massive amounts of shareholder value, all in a desperate bid to build a $15 a month subscription app to rival Netflix.
And Fox didn't play that game.
No, they didn't. They stayed out of the subscription bloodbath. They focused on free, ad-supported streaming, live sports, and live news.
They protected their margins, generated billions in free cash flow, and bought back a third of their company.
So it leaves us with this final thought for you, the listener, to mull over. Does Fox's boring, highly profitable quarter prove that the rest of the legacy media industry ran full speed off a cliff?
It really makes you wonder if the entire sector chased a subscription mirage, while Fox quietly built a fortress around the oldest, most reliable business model in television.
Selling highly targeted ads to a massive captive audience. It definitely forces you to question the foundational assumptions of the entire media sector strategy over the last 10 years.
Absolutely.
Keep digging into the numbers, look past the flashing lights at the headline revenue, and remember that the most lucrative opportunities are usually hiding in the quiet hand. Thanks for joining us, and we'll see you on the next deep dive.